Thanks. I forgot what day it was. Thanks.
All right, that does it for today's market action here. All three of the major averages, like Ines just said, holding on to gains, closing just around the highs of the session. Dow up just over 300 point, S&P in the green, as well as the NASDAQ. The NASDAQ up just around 1.7%. You just heard Ines mention the fact that the NASDAQ 100 posting its biggest gain that we've seen in just about 2 weeks. Sector action. Most of the sectors here closing to the upside. Some of the biggest gainers coming from technology, communication services among the leaders here in today's action, as we see the big cap names really set the pace. For more, let's bring in Eddie Ghabour. He is KeyAdvisors Group owner and author of Common Sense Bull. We also have Zach Hill, Horizon Investments head of portfolio strategy. Zach, let me start with you. We certainly seem like we're in this holding pattern because volume's been very light. If you take a look at the action over the last couple of days, all eyes on Jackson Hole, what we're going to hear from Jerome Powell tomorrow. What are your expectations and your reaction to what we've seen play out in the market over the last couple of days?
Sure. So, I mean, this really does feel like an August market after a really, really tough year. As you said, volumes have been low. I've been getting a lot of out of office emails when I try to, touch base with people I know in the market. And, quite frankly, I'm not surprised that we've seen volatility ahead of Jerome Powell's speech. We haven't heard from Chair Powell since the July Fed meeting. And, since financial conditions have loosened, markets have rallied a good bit. And so there were some jitters coming into things. We saw that last Friday and this Monday. And, we were expecting, Chair Powell to stick to the message, which is higher for longer rates. And we thought markets would rally from there. And I think the market is doing a little bit of that activity, early in today's price action.
Eddie, Jim Bullard, St. Louis Fed president, earlier said he hopes front-loading rates at 3.75 to the 4 range this year shows they're going to be serious about fighting inflation. He also seemed to insinuate that the markets are not listening to what the Fed is saying. What's your expectation for tomorrow and your reaction to the 3.75-4 range this year?
So I think that the market has this wrong in regards to the Fed. I think that the market is really positioned for a Fed that's going to pivot or become dovish. And I think it's very clear that we're not close to where the Fed wants to see inflation. So, if they come out with a very hawkish speech tomorrow in regards to monetary policy, you could certainly see the volatility pick up to the downside. And I think once we get to September and everyone's back from vacation and volume starts to pick up, that's the biggest risk. I think right now the market is positioned for perfection from the standpoint of a soft landing with a combination of a dovish Fed. So if it's hawkish with a hard landing, that's where the big problem comes in. And this is why we're continuing to stay very defensive with a lot of cash. We want to wait and see what direction they go in. Our money is betting that they tighten higher and longer than what the market is actually positioned for. And then we'll have a better entry point in the fourth quarter to dip back into the equity side.
And Zach, when you look at how the markets are reacting, do you think they're pricing in enough of the headwinds right now from the Fed?
I think I would agree with a lot of what Eddie just said. We as well think that rates are going to have to be higher for longer. That doesn't necessarily mean, 4, 5, 6%, but it maybe does mean that we're going to be at 3.5% for, at the end of this year and all of next year. And quite frankly, markets are not priced for that. We're still pricing cuts in 2023, and we pushed some of those cuts that we were pricing a couple of weeks ago into 2024. And as we look at it, that's kind of very much looking at the Fed of 2011 or 2015 or 2019 when they were cutting rates in the trade war. And with inflation at 40-year highs, we just don't think the Fed has that much latitude to be that concerned about growth right now.
So, Zach, you say 3.5% by the end of this year, possibly next year. Eddie, you were saying that you expect the Fed to tighten for longer than what the market is expecting. How much more aggressive could the Fed potentially get?
So the market right now is expecting the Fed to pivot and start potentially cutting rates in the beginning part of next year. And I don't see that happening. Let's face it, the Fed doesn't cut rates until the economy is in the tank, the market's in the tank, and we need to inject liquidity. We're far from that right now. And so they're going to tighten after all. They're going to go ahead and switch their stance from tightening after the wheels fall off. And I hate to be so dramatic, but let's face it. We have a strong dollar that continues to strengthen, which is hurting multinationals, which is going to hurt earnings. We have inflation at 40-year highs. The only way you're going to get inflation in is demand destruction, and you create demand destruction by having a recession. And we are right now positioned for a recession. We think we'll have a global recession. This reset will be healthy for the long-term prosperity of the market. But there's a lot more pain that we have to feel first before we can move forward. Because, again, the Fed would probably rather over-tighten and make sure inflation is down versus not tighten enough and have what happened in the 70s and have a big spike again. They do not want that. That would completely destroy credibility.
So, Zach, do you see it as Eddie does, or do you see it as Nobel Prize winning economist Richard Thaler sees it? And he said this morning he doesn't see anything resembling a recession.
You know, the soft landing is going to be tough, but I would push back on what Eddie was saying a little bit. I think it's going to take more time for things to slow down. Quite frankly, we just came into this shock of higher commodity prices due to the war in Ukraine and higher interest rates on the back of that. You know, that's relatively recent, and the market is digesting that. We came into that shock with a ton of forward momentum. You know, you saw the GDP numbers; they were revised up today. There were a lot of technical reasons to think that you know, the underlying economy is stronger than you know, what those two negative quarters of GDP has said. And so, as we think about it, you know, we are defensive as well, but we're not positioning for that kind of full-on, you know, recession trade at the moment. You know, utilities and staples, they did a lot of work earlier this year, and that was a big part of our allocation. And we've been switching, you know, to a little bit more to the growth side, although not overweight by any means, and looking for some higher quality names there that we think will do really well as we're in this kind of waiting period as inflation comes down. But, you know, it's a real question of how fast it comes down and how and where it ultimately settles. That we don't really know that at this point.
And Eddie, on top of what we're watching from the Fed, you obviously have the 10-year still above 3%. And then we're also taking a look at what's been happening with the strong dollar as well. How do you position yourself in this sort of environment?
So right now we are positioned, we own utilities as well too. And the interesting thing is when we had this bear market rally, utilities was one of the best places to be, which you wouldn't think you would have in that type of rally. Normally you would think that was a much more of a risk on strategy. So that kind of supported our defensive thesis. Again, you need to be careful with the multinationals right now because of that strong dollar and anything that's interest rate sensitive. We think the 10-year could go back up to 3.25% by October. We've already seen a big jump from the 2.6 up to where we are today, and we could get a spike in rates on that 10-year tomorrow if the Fed comes in hawkish. So you need to be careful with interest rate sensitivity, number one, and of course anything with the dollar, because I think you're going to see earnings have to get revised down. You've got a recession potentially in Europe on top of a strong dollar. It doesn't bode well for them. So again, one of the hardest things to do as an investor is to be patient, to be more opportunistic. But that's the stance we're taking now because, again, we think these next 2 months will certainly create some downside risks.
All right, got to leave it there, guys. Eddie Ghabour and Zach Hill, appreciate you both being here. Thanks.